Good morning, and welcome to Improving Business Cash Flow, revolving lines of credit for startups and small businesses. My name is Nate Miller. I am the Business Development Representative for Genesis Capital Finance. And today we're going to be talking about what is accounts receivable financing or factoring, the types of financing or factoring, which is recourse and non-recourse. How does AR financing differ from traditional bank financing? The benefits of AR financing for a business. How does it work and what are the costs? What AR financing isn't. And finally, how to get the most out of your AR financing relationship. So what is AR financing? Well, AR financing is a way to expedite cash flow by leveraging your accounts receivable. It falls under the category of asset-based lending because you're using an asset, in this case your AR, as collateral for the loan. There are two different types of AR financing, recourse and non-recourse. Under a non-recourse relationship, you would actually sell your receivable to the factoring company. The advantages of this are that once you sell your receivable to the factoring company, the factor assumes all the collection risk. The disadvantages are that there's usually a very heavy verification process. The factor will definitely contact your customer and definitely want to talk to them to make sure that this receivable isn't valid and that the goods have been received and delivered. The customer will also most likely have to make the check out to the factor. They will no longer make the check out to you. They will actually make it payable to the factoring company that you sold your receivable to. And typically in this type of relationship, there's a heavy discount from the gross invoice amount, which is how the factor makes their fees. Under a recourse relationship, you advance money on your receivable. The advantages of this is that they're significantly lighter or less obtrusive verification procedures. Typically, the factoring company will want to try to incorporate the verification into your existing processes. So they might attach themselves to an email that you send to your customer asking that if they received the goods and if the invoice is valid. In addition to this, your customer will continue to make checks out to your business. They will most likely be given a new address, like a lockbox address, to remit the payments to, but they will continue to make the checks out to you. The nice thing about a recourse relationship is that the fees are typically based on how long the invoice is outstanding. Therefore, it's easier for you to manage costs. The faster you collect your invoice, the lower the fees. The disadvantages to a recourse relationship is that you still have shared collection risk with the lender. Now, how does it differ from traditional bank financing? Under an AR finance relationship, the credit decisions are based on the strength of your customers, which the factoring industry calls account debtors, not the strength of your company. By looking at the financial strength of your customers, the AR financing companies can mitigate some of the risk of loaning to a new or unprofitable business. Let's use an example. We'll take a fictional company called Joe's Machine Shop. So let's look at the assumptions. Joe started a machine shop business specializing in aviation parts. The company has only been in operation for 6 months. The company is not yet profitable. Joe has a low credit score due to having to leverage personal credit lines to start his business. And as factoring companies, we see this a lot. You have a startup company where the owner has to leverage all their personal credit just to kind of get things rolling and to keep supplier lines of credit open. But Joe sells to companies that have a good credit reference. Joe invoices his customers on net 30 terms, and his customers typically pay him in about 45 days. But Joe often struggles to make weekly payroll and other operating expenses due to the timing of his cash flows. Joe would be a perfect candidate for an AR financing relationship. But how does it work and what are the costs? Well, fees can be structured many ways, but typically they are based on 30-day increments. Typical fees for a 30-day period range from anywhere from 1% to 4% of the gross invoice amount. Fees are always based on risk. 1% would be typical for a company that has some operating history, good diversity in its customer base, and some strong customers. Whereas a fee of around 4% would be more consistent with a brand new startup with 1 or 2 average strength customers. Remember, if you're a startup company and you're selling to one customer and that customer doesn't pay, the factor is going to have a very tough time collecting or recouping the money that they advanced. Whereas if you've been around for a while, and let's say you have 10 or 15 customers, if for whatever reason an invoice is uncollectible, they still have a large pool of assets that they can get repaid on. So let's walk through the example. Take Joe's Machine Shop again, and he's going to sell to ABC Inc. Joe delivers goods and invoices to ABC Inc. for $10,000. Joe then submits his invoice to the AR Financing Company for funding. The AR Financing Company then advances money on the receivables to Joe. In this case, 80% or $8,000. 30 to 60 days later, ABC Inc. mails $10,000 to the AR Financing Company. Remember, they're still making the check payable to Joe's Machine Shop. The AR Financing Company then pays back the loan of $8,000 that they funded Joe's Machine Shop, and then they rebate the 20% back to Joe's Machine Shop, less their fees. Now let's look at a fee example. Let's use Joe's $10,000 invoice and assume the following. Joe's factor charges him a 2% fee for every 30 days the invoice is outstanding. Joe invoices his customer on net 30 terms, and his customer pays in 45 days. Based on these assumptions, Joe's fees would look like the following. Days 1 through 30, he paid 2% on that $10,000, or a fee of $200. Days 31 to 60, he'd pay another 2% on that $10,000, or $200. So his total fees for that entire cycle would be $400. Now let's assume Joe has a 20% gross margin on sales. Under that assumption, he'd have revenue of $10,000, he'd have a cost of goods sold of $8,000, and a gross margin of $2,000. Taking out his factoring fees of $400, he would still be left with a gross margin after factoring fees of $1,600, or a gross margin after fees of 16%. But if the factoring fees helped Joe out, it enabled him to make payroll, keep material flowing so that he can, get more out of his existing supplier lines of credit and turn more orders, take on more orders, hire more labor during an expansion period. Then the factoring benefits Joe's Machine Shop and makes sense for Joe's. We've kind of talked about what AR financing is and how it can help, but let's look at what AR financing isn't. It is not a substitute for poor collection practices. That's quite the opposite. When you are factoring your invoices, you want to tighten up your collection procedures. Remember, the longer your invoice is outstanding, the more fees you're going to pay. So if you can tighten up your collection practices and collect those invoices sooner, you'll pay less fees. And also remember, under a recourse relationship, the factor will typically charge back an invoice that is not paid past 90 days. It's also not a cure for companies losing money. If you are losing money and not growing, why would you want to increase costs through factoring? Factoring is there to expedite your cash flow to help you meet current operating expenses. But if you're losing money and your company's in a downward trend and not a growth period, factoring will just kind of pile on more fees that you don't really need. It can be used as a tool during a restructuring of a company, but that should be combined with a well-executed turnaround plan. It's also not a financing option for long-term asset acquisition. Factoring is just expediting your cash flow. You should use factoring to meet short-term expenses. If you want to look at purchasing some machinery or equipment, you should look at an equipment loan. It should be used for meeting current expenses such as inventory, payroll, rent, etc. Let's talk about how to get the most out of your factoring relationship. Use your factor to supplement your credit department. If your AR financing company will not loan money on one of your customers, there is a reason. And always remember, sales do not keep your doors open. The cash collected from those sales does. Factoring companies are experts in evaluating the risk of companies. That's why they're able to advance money to a startup. Remember, they're looking at your customer base. So if for some reason your factoring company comes back and says, you shouldn't sell to ABC Inc., we don't think they're a good collection risk, and we're not going to advance money on it, you might want to think about possibly getting a down payment from ABC Inc. Or not doing business with them altogether. I see this a lot with startups. Startups are so excited to get sales that they don't really look at the quality of those sales, and that can be dangerous over the long run. Another thing you want to do is take advantage of any discounts being offered by your suppliers. I don't recommend a company offer 210 net 30 to their customers, because you never know if they're going to pay. And that 2%, if you annualize that out on that rate on an annualized basis, it's like 73%. You're far better off entering into a factoring relationship where you know you're going to get the money in 24 hours versus offering your customers a 2% discount. I've also seen it where the customers will take the 2% discount but still pay in 45 days. And it's kind of an awkward call to call your customer and say, hey, especially when you're a startup, you took a 2% discount even though you paid us in 45 days. It's not a fun conversation. But do take advantage of discounts being offered by your suppliers. If you get the advance from a factoring company and you see one of your suppliers is offering you a 2% discount to pay within 10 days, pay that invoice and save yourself some money. You should also create and maintain a cash forecast. This is one of the best things a startup company can do. By creating the cash forecast, you now see the upcoming expenses and also forecasting your upcoming receipts. So it enables you to only advance money or factor an invoice when you need it. Example, if you have a client today, but you know that you won't need the cash till the end of the month, don't submit the invoice today. Wait for 30 days when you need the money, and then submit it to your factor. Now you've just changed your factoring fees from a 60-day block of period or 2 months worth of fees to just 1 month. So you're paying far less and you're getting that cash still when you need it. But also, remember that factoring companies like Genesis Capital Finance, we know that we are a stepping stone. We are there for those businesses that aren't yet able to obtain bank financing. But we also know that we're a bridge. Typically, our customers are with us anywhere from, I would say, 6 months to 2 years. And at that point, we really do want them to transition onto a bank. But in order to do that, you need to begin taking the necessary steps to make your business bankable. So talk with your banker on what the requirements are, and always make sure you prepare and keep good financial records. And to come back on the 90-day cash flow forecasting, I think that's an excellent place to start. Okay, so that pretty much does it. Again, my name is Nate Miller. I'm the Business Development Officer over at Genesis Capital Finance. If you are interested in learning more about factoring or think that factoring might be a solution for your company, feel free to reach out to me. My phone number is 602-574-9724, or you can reach me at natum@genesiscapital.net. Thank you for your time, and everyone have a great week.